Coming up on today's episode.
Most of the time some of the property investors, they will think that they will buy one investment property and that is the solution to all their problems. It doesn't work that way.
We would all do it.
Yeah. Right. It's just that when you get into the property investment, I always tell my clients that you need to have a mindset of at least building 3 to 5 investment properties portfolio.
Dodgy advice and bad decisions can cost you big in real estate. We're here to make sure that doesn't happen. Welcome to the No BS Real Estate Podcast. I'm your host, Jo Agresta, and it's time to take control of your property journey together.
Hi, I'm Parth Shah from Jabsons Finance. I'm on a No BS podcast today. We are talking about how to avoid expensive mistakes while purchasing your first investment property.
Welcome back, everyone, to the No BS Real Estate Podcast, your listening how-to guide to the Aussie finance and real estate market. I'm your host, Jo Agresta. Now, today, we're talking about something that a lot of investors struggle with, and that is knowing how to finance the next property properly. Because when you're investing, it's not just about finding a good property, chasing a hot suburb, or buying whatever someone said is about to boom. It's about understanding whether the deal actually works for your financial position. So, question would be, can you afford to hold it? Will the bank approve it? Is the loan structured properly? Will it help you buy again later, or will it box you in? And just because the bank says you can borrow a certain amount, that doesn't mean that you should. So today, I'm joined by Parth from Jabsons Finance. Parth's an investment-savvy mortgage broker who helps buyers and investors understand their borrowing power, their structure, or helping them structure their loans properly and think through how one purchase can affect the next one. So in this episode, we're unpacking how smart investors finance their next property, what they need to understand before they buy, and how to know whether they are actually ready to scale. So Parth, welcome to the show.
Thanks for having me.
Oh, I'm so excited to have you. I enjoyed our first conversation so much when we were chatting.
Very interesting.
Very interesting. And we went through so many holes and angles and options. And then we landed on today's topic, which I loved your personal story about your own investment journey. And I'm like, okay, well, this is interesting to have someone of your background in the finance side.
Absolutely. Now, look, that is how I got into mortgage broking industry, when me and my beautiful wife bought our first investment property. And our loan was structured so bad that we ended up picking part-time work as a cleaner and over the weekends. That is to meet the shortfall. And that is when I started doing research about this wonderful industry that I'm part of today.
Yeah.
And immediately got hooked. And I decided to be a broker to make the difference. Yeah. And I'm glad that me and my entire team is doing this very effectively at the moment.
No, that's what's stood out to me, to be honest. It's the humble beginnings. And then I think all of us in this industry that come into it, we start with a bad experience. It's like the gateway into, no, I'm not going to have this experience happen to anyone else. I want to fix it. And I feel like that's why, the No BS podcast is the perfect name, because we are no BS professionals at the end of the day. We want to make sure that we're doing the right thing.
Absolutely.
So I think, when I guess you said that your first property was like an investment, is that the first property you purchased?
No, that was the second property.
Second one.
Yes.
Right. So you purchased your own owner-occupier home first with your wife, and then you moved into investment.
That's right.
Tell me a little bit about how you transitioned into that, because that's it's a pathway for a lot of home buyers that I think after they buy that first home, they start to think about.
My main reason that I got into the investment was me and my wife we were earning handsome money, right? But at the same time, we were paying too much in tax at the same time as well. And I was listening to all these podcasts and videos that I was watching, property investment, and just found out that property investment is a very good way to minimize your tax bill, right? But then I got in touch with some of the groups, but they were selling the property on the back end, those properties that I didn't really like. So I started doing my own research. That's when I invested in a property first time, but then my loan was not structured correctly. And that's when I started doing research that how the loan should be structured, what is the right way to structure according to your circumstances, not what you watch on the videos, because that is all general advice.
Correct.
Everyone earns their income differently. So that is when I did a little bit more research about this broking industry and structuring and all those things, and immediately got hooked.
Well, yeah, I can. It is a hook. So this industry, I left once for a period, and then I never actually left. I went back part time.
Oh,
I couldn't leave. I just loved property.
yeah,
So
it is very interesting industry to be
'cause
part of.
it's always something different. I think
It
every
is.
client is different. Every situation is different. Every
Yes, that's right.
experience, it's never linear.
That just keeps you on your toes,
Oh, tell me about it. And I guess, when an investor comes to you, wanting to buy, their next property, right?
Mm.
Like, what does your process usually look like from that very first conversation, through to, the final stages of offset?
When the investors comes to us, of course, we'll do those basic checks, right? Find out their income, expense, borrowing capacity, cash flow, all those things. But the biggest question that I ask them that why you want to invest in property? What is their why? What is it that they are trying to create? Is it building the wealth? Is it tax minimization strategy? It is just that because they have some money, their friend have done the investment, so now they want to invest in a property. So finding out their why is very important. And then we will collect all those documents that will help us check their borrowing capacity and affordability. And once we know that, then we'll do a strategy session. That is where we'll let them know that this is where you stand in. And that is where we have that interactive conversation with them, try to understand their why in more detail and let them know that this is where your strength is. And if I'm at your position, this is what I would do, not what your friend has done,
I think that's a common one. It's that the peers, right? It's like your friend has done it, your friend's friend has done it. All your friends seem to be buying houses and you're the one that's not doing it. So then you feel that like, okay, I better do it. And you would have that all the time where sometimes their why is different to when they first come to you.
Oh, yes.
You dig in.
Absolutely. I mean, their why is what they have what they have understanding about their finance and the borrowing capacity and affordability. But once they will come and see me, I will have the numbers. I'll let them know some real results and how they can do the same thing, but a little bit differently. If they will tweak it, then the result will be a lot better and more favorable to what they are trying to achieve, and they will get there a lot sooner, a lot faster. Yeah.
It's hard too, because like for them in their position, they always come with their own ideas or plans or things they've researched. And then you're like, not in your position. It's like, or maybe sometimes, yes, in your position, you could do that. So you're the professional to kind of steer that, in the right way.
Yeah, absolutely. And we have to reason. I mean, not that research they have done is wrong, right? No. But it's just sometimes it's not up to date.
Yeah.
Right? It's just not up to date according to current lending environment or scenario and how the bank is assessing it, because lending is a constant changing landscape, right? Okay. So what we have done a month ago, we'll try to do the same thing today. We might not get the similar outcome. So
that's true.
That is where we have to educate our clients that, okay, well, the information is correct, but if you try to execute that, it's outdated, nothing else.
And that kind of leads me into the types of clients you work with. Are you mainly working with like your first home buyers, investors, or is it pretty mixed?
Oh, it's pretty mixed. So 35 to 40% of our clients are self-employed and high net worth individuals.
Yeah.
15 to 20% is first homeowner buyers, 20 to 25% is complex structures, trust and company and family trust and so forth.
I think that's a whole episode, the family trust, because people need it broken down every time. I haven't had it yet. Maybe that's the next one we do. Well, I can't go any further before I put our no BS statement of the day on the table. So this is, for those that are new around here, every episode we have a statement called the no BS statement of the day. And at the end of the episode, we're going to have you determine, Parth, whether it's bullshit or not bullshit. So I'm going to read the statement now, but we'll come back and I'll remind you at the end.
Okay.
And you can determine if you think it's BS or not. So today's statement is, the property gets the attention, but the loan structure decides the outcome. So we're not going to answer it yet. We'll sit with that for the episode. All right. So like I said, this episode today is mainly about financing that next property, that you want to purchase. And typically that is an investment. It's not always like the second under occupier home. So that's the specific landscape we're working in today. So let's start with the basics, because I think a lot of people jump straight into suburbs, asset type, budget. And there's no thought for, okay, but what can you borrow and what are we buying and how are we buying it? So when someone says, I want to buy an investment property to you, what do you need to understand about their financial position, like before they even start? looking seriously?
The first thing I need to understand that why. What is the reason why they're looking to invest? Second thing is the affordability and a borrowing capacity. These two things are different. Okay, lots of people, they get mistaken with their borrowing capacity with their affordability, right?
Yeah.
Because if their affordability is $1.2 million, they will go out and just buy one investment property worth $1.2 million.
Yeah.
And there you go. They have boxed themselves for a very long time, and they will miss out on all those future opportunities that will come their way, because all their surplus funds is going towards managing one particular property. So educate them, right? That, okay, well, property investment, you don't get into the property. Most of the time, some of the property investors, they will think that they will buy one investment property and that is the solution to all their problems. It doesn't work that way.
We would all do it.
Yeah. Right. It's just that when you get into the property investment, I always tell my clients that you need to have a mindset of at least building 3 to 5 investment properties portfolio. Of course, whatever the time frame that you will decide, 3 years, 5 years, but that is how you should be designing your investment strategy, right?
Yeah.
And we can help you map that out, right? Because not every single decision that you will take, it will turn out to be a right decision, right? So the important thing is that you need to take a decision, right? And the property growth, infrastructure, lots of other external factors that will decide that turns out to be a right or wrong decision.
Yeah.
Which will be not at that point of time. These sort of decisions will take some time, 3 to 5 years, before you will see the growth or you will see that high rental yield. Yeah.
Yeah. You've got to build.
Absolutely.
Right?
Yeah.
And, going back to your point, borrowing capacity versus, your affordability assessments, so the borrowing capacity, explain that for our listeners who are sitting there going, I'm going 1.2 million. No, wait.
So borrowing capacity is typically assessed based on your income and expenses, right? And bank will go and say that, okay, well, your borrowing capacity is X amount, $1.2, $1.3 million. So that is your borrowing capacity, right? But your affordability depends on your future plan. That, okay, well, I'm traveling next year, getting married, planning to get, kids, planning to take some time off. So all these other external factors that we need to keep in mind. And then we need to come to the budget that, okay, well, now based on this, how much surplus funds that you will have left over once you will get into that situation. And based on that, you should aim for the investment property that you want to purchase rather than just based on your borrowing capacity. Does that make sense?
Very well explained. Yeah. Yes. And that's true for what you're saying, then that example of, let's say your affordability assessment is at 1.2 million, that people think they have to go out and buy the property for the 1.2 million. But in a lot of cases, that could mean even 2 properties, depending on, obviously, what you can.
Because when you don't assess these sort of things, what happens, right? In property investment, you make money by holding property for long term. Okay. Right. Long term. The simple way, how you make money in property, okay, is by holding the properties for long term. How you will hold the properties for long term? When you have all these life situations comes your way, right? What sort of plan that you have for those situations, right? That is what will allow you to hold on to the property for long term. So always buy the property, investment property, based on your affordability, not based on your borrowing capacity. That will increase your holding capacity.
Yeah. And this is kind of like a formula that I'm going to put as a visual when we're talking, because what I'm saying is it's so well explained. It's that holding and that future potential. There's a lot of people, I think, like you said, where they can go wrong is they make the investment, they put all their money into one property, but then when things go wrong and they don't account for those buffers like job loss, or children coming into the picture, even divorce in some cases or separation, all these things not being factored into the forecast.
And that property goes first.
Correct. It's the first thing, right?
The first thing that you will sell is that property.
Just
it doesn't matter what the market is. You just have to sell it. If it's turned out to be a good market,
fantastic for you.
But if it turns out to be not so good market,
then it hurts to get rid of it. So this is why this topic is so important. And I guess, what do you think a lot of investors misunderstand about, their situation? Like, is it what you were kind of saying about the affordability versus the borrowing, or is it a few things?
It's a few things, right? The first thing is the mindset. Right. Okay. Like when you become an investor, like I said, you need to target minimum 3 to 5 investment properties. If your borrowing capacity is $1.2 million, how you can purchase multiple asset in that $1.2 million and purchase multiple asset in a different location, right? Don't just buy in your backyard. right? Have the expert advice, have someone in your corner that you can reach out to who can help you structure your finance, who can help you guide you in a way that, okay, well, what is good property according to your income and expense, right? So that is very important because every property investment journey, it's like a team sports, right?
It is.
Every property has a different role to play. Some property is good for the capital growth. Some property is good for the cash flow. Some property is good for the tax minimization, right? You need to have mix.
Yeah.
So that is one thing that I often have to educate our new investors, and most of the people get it very clearly. Okay, well, what I'm saying, it makes sense, right? And it's just that how we can leverage.
Correct, because I think that's where a lot of people also box themselves in with buying in their backyard. People don't think it's possible for some reason to buy interstate, and it's like, but you can. There's a market that suits your budget better, and it's in Queensland, or it's in New South Wales.
Yeah, well,
and it's like it's doing the things that you want it to do.
Yeah, property investment, end of the day, property investment, I tell my clients that treat property investment as a business.
Yeah, 100%.
Right. And when you treat property investment, when you're doing business, you do business with other people's money.
Yeah.
Look at all those big organizations, right? They have enough in their surplus account, but they will still list themselves on a stock exchange and use that money for their future business expansion, right? So the same thing that property investors should do on a smaller scale, right? In this case, other people, it is a bank that I'm referring to. When I say that other people's money, that is a bank that try to do property investment business as much as possible with the bank money. Yeah, by structuring your finance correctly.
Yeah, it makes sense. And it leads me into, I guess those key numbers that the investors need to look at too, because I think this is important. Like the number that an investor needs to understand before buying, like what are they in your opinion, like especially around repayments, rental income, buffers, holding costs, future borrowing power. Like what are some of the things that they need to be aware of?
What they need to be aware of is what sort of, this is, multiple things are coming in my head.
Yeah, I can see the cogs moving. You're like, okay, hang on, I've got this.
It all depends on how you're earning your income, right? And what sort of surplus cash that you have, right? And at what age you're getting into the investment property building, buying your first investment property. So there are multiple factors that plays very important part. But if I will give you like a general advice, how I started with the small land and build the house on it and then keep on building up from that and did my tax minimization to certain level. And then I bought the property in a developed suburb where there is a higher growth, but at the same time that whatever the gap was between the rental and a repayment, right?
Yeah.
That gap was getting filled by the tax minimization that I was achieving from other 2-3 small investments that I have done.
Yeah, so this is what we're talking about. Like property unlocks a lot. And I think when people hear, they're a millionaire, they've got 5 investment properties, it's like on paper, what's happening is money is moving around between all these properties. One's feeding the other, one's a different strategy altogether, one's for capital growth, one's for tax minimization, like you said.
Yeah.
And I guess that first investment you make is so important because it's the foundation of that portfolio.
Absolutely. That investment will decide that either you're boxing.
Yep.
Or you're buying your next investment property next year.
Yeah. And I think that it's such a wild concept for a lot of people that they can't believe that they can even do that after 12 months or after another 2 years. They're like, really, I can buy another one. It's like, if you buy that first investment well, yes,
Absolutely.
You can. But if you want to max out the $1.2 million, buy that holiday house at the beachfront and you want to rent it out as an Airbnb and that's the strategy, it might work. But also you're putting all your eggs in one basket. If that strategy doesn't work, then what do you do?
That's right.
That's the risk.
That's the opportunity cost for the future.
Exactly. So there's that other kind of factor is the opportunity cost. It's the holding cost and the longevity of that property. It's like, how long can we hang on to it? Like you said, it's a long game.
Yes, absolutely.
And like, this is the perfect time to kind of talk about like that growth and serviceability kind of side, because investors often talk about, capital growth, rental yield, but from the finance perspective, how do these two things affect borrowing and holding the property?
Look, this is the thing, right? Capital growth and rental yield. Capital growth it is not in our hand. As an investor, our job is not to, yes, we can forecast the capital growth to a certain degree, but we don't know what is going to up, what is going which property is going to go up in the price, what area is going to go up in price, right? I have done more than 3,000 home loans. If I knew about that, I won't be doing home loans.
No.
I'll be just simple buying and selling properties.
You're the best real estate agent in town.
That's right. Okay, lots of real estate agents be doing the same thing, right? Okay. So that is the thing, that capital growth is not in our hand, right? As an investor, your job is to buy a good asset in a good location where lots of owner occupiers and family prefer to live.
Yeah.
Okay. That is the basic thing, right? Look for the structure of the property, right? See if it's any future potential that property has, subdivision or anything like that, right? So invest in that sort of property, right?
You want to do it like where you can add value.
Yeah, you can add value. And at the same time, understand why you're doing what you're doing, right? It is, don't mix the ambition and the ability, right? Some of the investors, they don't have a time with the busy family and everything, and they will purchase something which they can subdivide in future. But then, if, that is, you're adding things in your plate, which you won't be able to fulfill that project for good 2, 3, 4 years. And then you will miss that window of opportunity, and then we'll stuck with that property for a very long time.
Yes, it's a holistic approach, right? It's you have to factor so much in. And I think this is why working with someone like yourself, like you're asking those questions at the right time to these, clients who are thinking about doing this. It's like, well, are you really going to do the renovation, with your 3 children that are all under 5 years old in the next 5 years?
Absolutely.
How realistic?
And how often that, renovation, 99% of the time, it always goes above budget, so you need to,
there's so many factors,
absolutely.
Right? And it doesn't mean that they're not viable strategies, but it's that planning that you do with, the broker at the beginning is fundamental.
You need to plan for the things that when things doesn't go as per the plan.
Correct. And I think a lot of people miss that step, to be honest, because we get so excited about the fact that we can even purchase. It's just an emotional thing. It's like, oh, what, we can buy something. All right, let's go buy something. And you get the excitement, but all the stuff that you need to think about when people do it by themselves, or, they do it just by using the bank in particular. They overlook so many factors and they box themselves in. And it's like, that's it. That's the property. You've put all your, eggs in one basket now.
Yes,
what are you going to
do? That is the reason that this day and age, it's not as simple as getting the loan approval, right? It's about that who do you have in your team, whether that is real estate agent, buyer's agent, property strategist, finance broker, right? It is that team plays very important part in guiding you. Well, of course, you take the decision at the end of the day, but it is good that you have someone in your corner that will ask you those good questions, that why you're doing this, right? And just challenging you in a good way, which will bring something good out of that conversation.
100%. The team around you can make or break your property journey, in my opinion. That's why I'm so passionate about just work with the right people, because if you have someone who doesn't care about investment as your buyer's agent, they focus on owner-occupier homes, and their specialty is not investment strategies, that doesn't mean they're a bad advocate. They're just not the right advocate for you for this position. It's like when you want to buy your own home, you go to that person.
Yes.
Like it's so many factors, even your accountant down to your conveyancer, your broker, like everyone works together to make this happen for you.
Couldn't agree more.
So exactly. So I think one of the other things I wanted to ask is about, especially from your perspective, because I talk to a lot of advocates, like I'm an ex-advocate myself, so I have my own perspective, but can a high yield property, in your opinion, still be a bad move from the lending or long-term strategy point of view?
Very interesting question. So now there'll be 2 examples to this. Okay. Right. It all depends. So high yield properties, some of our clients have purchased the high yield property in a mining town, okay, where they are getting high yield. They have contributed. Bank will see that as a risky lending. So bank will still lend you money, but traditionally bank will lend, say, 90% or 95% for some of the investment property in a good location. For this sort of location, bank will lend you 70%, right? Or in some cases 60%. Okay. But some of my clients have done really good after doing that, because they live and work in that area.
Okay. Yeah.
Makes sense? So that strategy has worked for them, right? Because they are living, they know what they're doing, who to rent out, who to contact, who is the local real estate agent. They have studied the market within that market.
Yeah, they're kind of buying in their backyard.
Yeah, because there is always a suburb within there's a good patch and a bad patch, and they know what is the good patch, right? Yeah. So if you know about that, high rental yield property and you're targeting those sort of areas, go for it. But if you don't know about that, then you will box yourself in with if you ended up purchasing a bad asset, then you will have to hang on to that asset for a very long time, and that will cost you
holding costs.
Holding cost plus holding costs will be very minimum because you will have
That's true.
high rental yield, but you will basically miss out on future opportunities that will come your way.
Yeah, it's like that. Like you said, you've boxed yourself right in.
Yeah, because you have invested all your equity or hard-earned cash in one property, and then your borrowing capacity, there is no buffer for you to invest in future.
Yeah. And this is why I'm going to keep reiterating this. First asset you purchase for your investment will set up your portfolio
absolutely
properly. So don't risk it.
Don't risk it. Just do proper research, have the right people in your team, and yeah.
And I think the other thing too, it's like from your perspective as well, like what does a good loan structure, because you said part of the reason why you didn't like your purchase was, the loan was badly structured, right? What does a good loan structure mean for an investor in simple terms? Like what are those like key things they need to be aware of?
In a simple term, okay, so there is a positive debt and a negative debt.
Yep.
Okay, if you're an investor, right, and purchasing investment property considered as a positive debt. So something what is positive, we want to increase as much as possible, right? So the good structure for me, it is to leverage equity that you have in your owner occupied property, okay, rather than using your own funds to fund the investment property.
Yeah.
Right. So that will classify as a good structure. But if you don't have the equity in your property, you can still do that using your savings. So it all depends on your individual scenario, what stage you are at, right? But good structure is very simple. Increase positive debt by borrowing maximum as much as possible on your investment property, but at the same and trying to keep your owner occupied debt as low as possible, and whatever the saving that you have, make sure that offset that owner occupied loan. So what this strategy will do, there is two things, right? One is that paying lower interest rate.
Yeah.
Okay. Which is, if I will ask lots of my clients or even new clients, I'm like, what is important in a home loan, right? The question is, interest rate. My follow-up question to them is, do you know how bank calculates interest on your home loan? No. How?
How?
Right. So that is where we design the strategy in a way that where they will pay overall interest very less. When you pay overall interest very less, right, your money is working for you.
Yeah.
And the good thing is when money goes to work, money brings money.
Yeah, it's true. It's like, because it's working for you. Like what you got to understand goes back to your comment about property being business. You're buying almost your own business. The buyer is obviously the tenant that's moving in. You're the business owner. You've got all the players, all the key stakeholders that need to be aware of what's going on. Who's funding the finance, the bank, like all of the work's very similar to a business.
Absolutely.
So it's the same in this case too. It's like, well, where's the capital growth and what's the point? Why are you doing this? What's the strategy? What's the exit strategy? It's the same thing.
So, and when you do a business, right? In business, you don't have the money, or you start doing business today, and after 10 years, that business will double in the value, and that is when you will cash out. Well, you need to have consistent cash flow.
That's right.
From that business, right? So property will generate the consistent cash flow from tax minimization, from the rental yield and capital growth. And it depends how you leverage on that capital growth. That is whole different.
This is a whole lot that we're going to have to half back for. And it brings a good question for this next topic, which is, the borrowing capacity and the future moves, right? Because now that we're talking about kind of like what all these factors mean. The part I find interesting is that first investment property is rarely just about the first property. And what you'll find as an investor, when you buy the first one, you're hungry for the second and the third and the fourth. You start to get excited because it's thrilling. It's like you see that property working and you're like, when can I do the next one? And you go back to the broker within 12 months and go, help me. So I guess what role, in your opinion, does the borrowing capacity play if someone wants to build a portfolio, not just one? So let's say you have a buyer that comes to you that their borrowing is actually quite high, and they do technically have capacity to buy multiple properties in a staged way. How do you approach that?
Oh, then I have to approach very carefully, right? It is like that you have this fantastic borrowing capacity, right? Which is definitely a good problem to have, right? And now just need to map out that overall strategy, that, okay, well, you have the borrowing capacity. Now, what is our second why? Okay. Why we want to invest? Okay, well, capital growth or tax minimization or both, right?
Yeah.
Okay. Well, if that is the capital growth is the strategy, then, okay, well, what areas that we can target? I mean, of course, we don't
That's the
advise
buyer's
on the
agent.
area that is buyer's agent or whoever they get involved with, but then we will design the strategy in a way that, okay, how quickly, if they have a strong cash flow, then you might design the loan structure as principal and interest. So you can pay off that loan a lot faster. And when you're ready to purchase the next property, we can use that equity from that high growth property that you have purchased. Hopefully that will go up in the price to fund the next property and the next. So yeah.
So it's all like a fine orchestra. It's like I feel
Absolutely.
like the broker's the conductor here going, no, yep, now you. It's all a perfect symphony that needs to work.
It is. And this day and age, especially where the valuation is an opinion, and this, I mean, what we are seeing that valuation plays a very important part for you to continue building the property portfolio, right? And what we are seeing at the moment that all the banks, there depends on their appetite, right? And depends on what areas they will consider as high growth and high risk. All the banks will value your property differently because it is an opinion, right? But opinion that matters.
Correct.
When you're trying to borrow money, right? So based on that, who is in your team, they can get that multiple valuation done for you and they will find out that which one will suit you the most. And that is what will determine that you will end up purchasing your second investment property in 12 months or 2 years.
Yeah. No, I think that's the big play here, right? Because I'm going to ask you the opposite question. I've been asking you how to borrow, how to do this. Now I'm going to ask you about the red flags, right? So, what would make you pause with someone and say, this might not be the right move yet? What are some of those financial red flags that people need to be aware of before they go off to the races?
Look, I mean, short-term businesses where they have seen the massive growth in first year or second year, where they haven't proven themselves and they think they are ready to go, right?
So these are like the business owners trying.
Business owners that they had really good couple of years, their idea they have implemented some ideas and it worked out really well. And they had a very good first, second year, but business is a marathon.
Yep, tell me about it.
So that plus if someone is expecting some sort of, getting married or growing the family, expecting kids and those sort of things, I'm like just take it easy, let's see how we go after this. Because sometimes I'm going to go back to work after
on maternity.
After within 6 months, but sometimes things doesn't go as we are planning. It takes 12 months, 18 months, 2 years. So I'm like, well, let's just pause it for now. We will get the ball rolling on this once you're actually back to work at full-time capacity. Then we can budget things properly.
Yeah, because I think that's part of that risk profiling that you're doing. It's kind of like that. Could that be a risk?
Yeah, that is right. Risk and the property investment is a joyful experience. Right. Okay. But if anything like this sort of life event will happen where things are not going as you have planned, body is not responding properly, there are external market factors will affect your business, then the joyful experience turned into the stressful experience.
Yeah.
Right. And when your client goes into the stress, you have to sort of help them, guide them. So it's better that we'll do it when the time is right. So yeah.
Yeah, you don't want people having none of us want you to have a stressful experience, especially with us with your professional helping you.
Right.
We feel terrible because you shouldn't be stressed.
No.
It's we should be prepared as much as possible. Obviously, life can throw curveballs all the time, with different things, and you can't prepare for everything, but you can minimize the risk as much as possible.
Yes.
And I think that's how you have to play property. It's same with business. It's
that's right.
I want to start a business today. I have startup funds of $20,000 of my savings. Do I want to risk my savings and do it? How long have I got with 20,000? Maybe a month, maybe not even set up. And then it's but if I had someone that gave me $100,000 to start a business or a loan, okay, maybe I'm in a different state, so it's all about that risk. How much do you want to risk to do these things?
It's normally residential property considered as a low risk because that is the reason bank is lending you up to 90-95% because even bank is considering this as a low risk. Right, versus commercial property. That is for another podcast again.
I think we're going to have Parth and I have come up with about 16 ideas. So next time I talk, you're going to say, hang on, let me watch your episode. We have the ideas. But yeah, it's true. It's different. Commercial's a whole other kettle of fish.
Yes, absolutely.
And I think, the best way to kind of bring this together is our listener favorite segment, and it's our Reddit Real Talk segment. So this is a bit of fun with you guys. Thank you to our listeners who submit these stories to us every day, a lot of the time, every week, definitely. And you're sharing either your experiences or experiences you've read about online, and you want us to unpack them with a professional. So today's professional, we have Parth. And I have this story that comes from the Oz Property Chat. So shout out to the listener that shared it. I'm going to read out the story, and then I want to get your kind of like response and reaction. All right. So ready to go?
Cool.
Okay. So this person, the post says, start with yield or wait for growth or property growth. And the post says, I'm looking at my first investment. Option 1, buy a 1-bed in a blue chip suburb now, about 8% yield, positively geared. Then in 1 year, buy investment property number 2, a property focused on long-term capital growth, which I then would be negatively geared overall. Option 2, skip the first apartment purchase and build cash flow to buy straight into a property suited for long-term capital growth, which would be negatively geared. Any experience is also appreciated. Thanks. So this is someone who's written 2 very loaded scenarios. From your finance perspective, is the property that is easier to hold automatically the safer or better first investment, in your opinion?
So apartment is hit and miss. Depends where you're buying apartment, right? Rental yield is, of course, very good. Rental yield, definitely a good cash flow, right? But at the same time, if you're earning $150,000, right, and extra $100 a week in rental yield, that will not have a huge impact on your lifestyle.
Yeah, that's true. But also capital growth with apartments.
Yeah, that's right. Capital growth with the apartments. Now, of course, apartments have, when we look at the Melbourne market in apartments, right? Different markets, different outcomes. Sydney apartment market is really good.
Yeah.
Melbourne apartment market in a right project.
Yeah.
If you buy apartment, then it definitely gives you that capital growth and a good rental yield. Not as much as compared to the land-based property.
Of course.
Right? So it all depends what problem that you're trying to solve. Both the strategies are right, but depends that what problem that you're trying to solve and what is how much you're earning, what is your income, what is your surplus.
Yeah, because if your income's 50,000, maybe we're not looking good.
Yes, then, if income is, if you're already on $150,000, $200,000 as a family income, and then you're looking for that extra $100 cash flow, and for that you will ignore everything good attributes that you should be focusing on while buying the property, and just look at that extra $100. That is not going to solve any problem. Extra $100. But if you buy the property which has the good attributes, today or tomorrow that property becomes a positively geared.
Yeah.
If you will hold on to that property for long term.
And in his case, what they're saying is, both properties, like if he does option 2, which is to skip the first apartment purchase, build cash flow to buy straight into a property suited for long-term capital growth, and they would never negatively gear it. But again, they're looking at negative gearing and capital growth in option 1. So obviously capital growth is their kind of goal, as well as the negatively geared property. So that would be like your tax minimization.
Yeah. So I would go for the property which is negatively geared right now, because this positively geared property word really got discovered in COVID.
Yeah.
Okay. If you look at the pre-COVID, what was happening, the traditional investment model was that you will purchase something today in 3 to 5 years time with the inflation. Okay. Rental will eventually catch up with your mortgage repayment. That is what was happening, right? Now we are back to that era. COVID is gone, right? But of course, the idea of capital, positively geared property, investment property, that is still there. So I would say that buy the property where you see the capital growth, and in 3 to 5 years time, you will see the rental will increase in that area, and that will eventually catch up with your repayments. As long as you have 3 to 5 years worth of holding surplus funds on a monthly basis, then yeah, I would go with that strategy.
No, that's very well answered. I think that was a very practical approach to that. So thank you for answering, and thank you to our listener for sharing it. I always love seeing what they send through. It saves me a job too, guys. And I think, too, like knowing when to scale is a big part of this. Like if we fast forward, let's say someone has done the journey, they've got their principal place of residence, they've purchased that first investment, and things seem to be going well. I think the next question is, like you said, you don't go into investment purchasing without planning the portfolio. Like, is the plan to add to this portfolio. That's what we should be looking at, right?
Yes.
So looking at when to scale, I think this is where people often misunderstand the timing and like what are the green lights that you need to have ready to say, yes, now is the right time, or not yet, you need to wait a bit longer. So for someone who already owns that investment property, how do they know whether they're ready to, I guess, scale, wait, refinance, restructure, or rethink their strategy before they buy again?
It depends on your mindset. But only what I say to our investor clients is, if you can afford, buy yesterday. Right time to buy property was yesterday. So time that individual, I'm not ready to buy the investment property. But when you will be ready, market will be different, right? So you have to be ready when the market is ready, right? Not the other way around. Yes, being conservative, it is, of course, not trying to, it is good. So have that enough buffer in your account, right? 3 months, 6 months worth of whatever your personal goal is. That once you have achieved that, then take that calculative risk and have someone in your team who can help you mitigate that. Makes sense? And guide you in the right direction that, okay, well, this is what you can do. This is how you can do. This sort of property will solve the problem that you're looking for. And these are the people and buyer's agent or property strategies who can help you.
Yeah, it makes sense, because I think that knowing when to scale is always like the hard call. Like, obviously it depends on many factors, but the why is very important, like you said. I think the other part to that would be, have you got like a client example of someone you've worked with who's been in that ready position, and then someone who hasn't been in the ready position, obviously without giving names of their life story.
Yes, of course. Yes.
Yeah.
So look, I will give you a very good example, right? One of our clients that I spoke with him, he's not our client at the moment. So we had a strategy session with him 3 years ago. 3 years ago, he lives in Adelaide, right? And he was ready to, he could have purchased the investment property, 2 investment properties in Adelaide when the property price was not as high as today, right? He's the broker that he was talking with, safe option. No, you should pay off your loan first, then invest in a property.
Gosh, right, okay.
He came to me, just had a word with him yesterday. He paid off his home loan, but now he wants to purchase next time because kids are growing up, they need to go to a good school. Now that house that he could have purchased 3 years ago for $800 to $1 million, now the same house is 1.5 to 1.7.
Oh,
so
knowing that information,
knowing that, he could have purchased that multiple investment properties, not 500, 600. That is what the market was in Adelaide 3-4 years ago, right? Easily, and that those properties could have gone up in the price. You could have sold that property and easily buy something else. So it's just that excessive buffer. Yeah. That is sometimes kills that property aspirations, right? So have that 3 months, 6 month worth of buffer, but don't just keep on building a buffer on top of buffer and buffer on top of buffer, right? Invest that money. End of the day, asset goes up in value a lot faster, and your saving doesn't go up in value that fast. With inflation, money loses the value. What 100,000 is worth today, the same $100,000 will be worth $95,000 next year.
I think this is the tough part, right? Yes. It's like you said it exactly right. The value of money changes, right? And sometimes people kill their own strategy by being so indecisive. Like they get let's say their affordability, and they get their pre-approval today to go buy this investment property. And then they sit on the market. Like there's a buyer that came to me 2 years ago. He still hasn't purchased, right? So he came to me just for a question. He doesn't want to buy his agent, doesn't want to pay the fees, just wants to do it at his pace. He wanted to buy in Port Melbourne. And I wanted it's like Port Melbourne, it was Collingwood, it was like a whole range. And I remember I said to him, last year I called him in December and I said, how are you going? Like, what's been happening? And he said, still haven't purchased anything. And I'm like, what's stopping you? And he goes, I just haven't found the right property. And I said, but the right property has come and gone over 12 months of looking. This is you're pricing yourself out of the market the longer you wait. So now where he was looking in Port Melbourne, it's like a big change of like 150,000 in some pockets where they're looking. And I'm like, you can't do it. And this is what I'm always talking about with buyers, that when you work with an advocate or the professionals that know how to guide you, when you follow the advice or you follow the guidance, obviously take everything that you need to hear with a grain of salt, but makes or breaks the strategy. Like
they do this day in, day out, right? And lots of investors, they will ask me, I'm like, oh, how you can make money by investing in property? My simple answer to them is by making a decision.
Yeah, 100%.
Very simple. Okay. And lots of investors, they put so much pressure on themselves by trying to make the right decision, right? That is the reason that I say that you need to have 3 to 5 right investment property portfolio, because not every decision that you will make, it will turn out to be right decision. Although that decision is the right decision when you have taken that, but because of so many external factors that play a very important part in capital growth, right, which is outside your control, right? So as an investor, your job is to make a decision and let the market do its thing, right?
And prepare for risk.
And just prepare for risk. That's why you will invest in a different location, right? So if something goes up, something will go down, so you can mitigate those sort of things, right?
Yeah.
And have the correct mortgage structure, which will increase your holding capacity, right?
Yeah.
And then something is not performing, you can just
pivot, change.
I
think that's the key thing, right? It's that understanding of you just got to plan for it, mitigate as much risk as you can. You can't mitigate everything. Yes. Right? But you mitigate what you can control. And I wholeheartedly agree with you that make a decision is the hardest thing, for a lot of these buyers, because when you know what your green lights are, if all the professionals, like sometimes I find, and this is not a criticism to our listeners, I love you guys, but sometimes in buying property, and I understand because, Parth's been there, I've been there, Karina, like everyone in the world has been there at some point. You put a lot of weight in that decision of buying a home, whether it's your own or an investment, and you don't want to make the mistake. You're going to have life hit you in different ways.
Absolutely. Challenges will come.
Challenges will come, and they will keep coming, and they will change. And it's like, as long as you've got an exit strategy, I always say it's like a business. Like, you don't start a business without knowing, well, why am I doing this to start it? And then when does it end? Does it end in 20 years? I want to have this for 20 years handed down to my kids, or do I want to have this for 2-3 years and exit because I want some big company to buy me out and then I exit? You got to know, how do you get out of this?
That's right. Absolutely.
And
you can mitigate the risk. Can't avoid it.
Exactly. You can't avoid it, and you can't delay decision, because the delayed decision costs you more in the long run. Always.
Absolutely.
Always.
Don't agree more.
I can't believe how quick our time's gone on. And I'm like, geez, we talked. Well, this has been such a productive and good episode. I can't let you go without the no BS statement, though, and your final thoughts. So we're going to return to our no BS statement, which, as a reminder, Parth, it was, the property gets the attention, but the loan structure decides the outcome. So final verdict, do you think that's bullshit or not?
It's not a bullshit.
We get our name today. Tell me why.
Because the right mortgage structure will, like I said, there is a positive debt and negative debt, right? Lots of people, they just focus, when they take a loan, solely focus on the interest rate.
Yeah.
Okay. Which is important. Don't get me wrong, right? To all your listeners, you're right that having a lower interest rate means lower repayment. But you still have that loan hanging on your head for next 30 years.
Yeah.
Right. So by having the right structure of your mortgage or investment loans, what will happen that you will pay overall interest very less. When you pay overall interest very less, your money is working for you. As a result, you will end up paying your loan a lot faster.
Yeah.
Okay. So that is why and that will increase your holding capacity. That will create more opportunity cost for you in future, which you will feel comfortable taking, right?
Yeah.
Okay. You will not,
as indecisive.
Because you have seen that it's working.
Yeah.
And paying off the right loan, what to pay off, what not to pay off, right? All those things you need to know. So that's why having the right loan structure, that is what will decide.
I love it. I'm just happy that we landed on no bullshit for today. So it means we get to keep the name. And my last question would be, for someone who's listening, at the moment, Parth, and they're thinking about buying that first investment, or they've got some options on the table, or maybe they're even working with a broker and they're not sure about the advice they're getting. What do you want to leave our listeners with, like, on their next step? Like, what should these listeners do as a next step if they're listening and they're,
Understand your why. Okay. And high rental yield is very important, but at the same time, ask yourself an honest question, that what $50 extra rental yield will change in my lifestyle? What will change because of that in my lifestyle, right? If the answer to that question is nothing, then focus on the right attributes when you're buying the property. Good location, family-oriented area, good property, those sort of things, right? And capital growth will happen with the time. Rental yield will also increase with the inflation. Look at all those rental areas in Queensland, South Australia, even in Melbourne, where the rental was 300, 350, 400. This day and age, it is 800, 900. I have this one property in Roxburgh Park, right?
Wow.
The rental was back in, it was 2017, 18 that I have bought. Rental was about 350. Today, that property rental is 800 plus.
Wow. All
right? So rental will change with the time. Okay, capital growth will change with the time. But for that, the key thing is what you need is the right asset class.
Yeah.
And the correct loan structure, which will create that future opportunities for you, not box you in.
Yeah, I love it. What a way to end it. Thank you so much, Parth, for sharing all your wisdom and all your thoughts with us. It's been incredible.
Thanks for having me. I have enjoyed my time here. Thank you. Thank you.
Of course. And like I said, we'd love to have you back soon. I think there's a lot we can talk about. I don't think we're short of topics, but again, thank you to our listeners for always tuning in. And I'll leave you with, the big takeaway from today's episode is that, smart investing is not just about buying, a property and hoping it goes up. It's about structure, numbers, your risk, your borrowing power, your capacity, and understanding how a good professional can help you on that journey. So for anyone listening who is trying to finance that first investment or trying to figure out whether they should invest at all, and you're sitting in the indecisive zone, my thoughts to you or my encouragement to you is get in touch with Parth. I always say it costs nothing to have a chat. When you're chatting with a broker, it actually costs nothing until the end with the bank. So they're paid by the bank. There's so much opportunity and it's all up to you making that call to take the courage, pick up the phone and have that conversation. It's not going to hurt. It's an honest conversation to see where you're at and where you're heading. So Parth's details will be on screen and in the show notes below. So thank you for listening. This has been the No BS podcast. I'm Jo Agresta and we'll see you next time. Bye for now. That's a wrap for this episode of the No BS Real Estate Podcast, powered by Abodi AI. If you found this conversation helpful, don't forget to subscribe, leave a review, and share this episode with someone who might need it. If you're looking for more guidance on your home buying journey, you can visit www.abodi.com.au for expert advice, property insights, and the tools you need to find the right home with confidence. If you're already on your journey, you can also download our app. Just search Abodi AI on the App Store or Google Play. Have any questions or want to connect, you can follow us on Instagram at abodi.com.au or send us a message. We'd love to hear from you. Thanks for tuning in and we'll catch you in the next episode.